what's going on, everybody? It's Monday, July 5th. Hope you had a nice July 4th celebration. Markets are closed today. Everybody taking it easy, I hope. But it is Monday, so I sent out the new edition of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. So obviously, everything pretty quiet today. I'll give you the rundown on some of the data. As we know, or as I've been telling you, fiscal flows are decelerating, but moderately. You know, they're not collapsing. They're still up about 780 billion year over year, 760 billion. Now remember, that's down from like over 2 trillion year over year. But that's normal because, remember, we're comparing it to this time last year when, you know, all the stimulus hit. But they are slowing down, and the thing that I like to look at are the daily flows, the average daily flows. That means the average amount of money the government is putting out there every single day in its normal course of spending, and that number is decelerating. In other words, the daily amount that is being spent is decelerating, and you can understand why. I mean, most of that probably is related to the cuts in unemployment benefits. You know, now we got just about all the states that decided to opt out. They're out. It's like 25, 26 states. Maybe another 2 or 3 are going out in the first week of July. So that pretty much explains the slowdown in the daily flows. One of the things I've been mentioning, and one of the things that we should anticipate, is that mid-July we get those child tax credit payments. Now, they're not as much as the unemployment checks. I mean, it's like $250 per child, I think, and that's paid monthly till the end of the year. But that will be something that we should see a pickup, a slight pickup in the flows from mid-July on. Other than that, I mean, the stock market looks more speculative now than it did in a long time. You maybe sense that my videos are a little bit more cautious, maybe outright a little bit more bearish. That's again because, you know, I go by the flows, and it's telling me that some of that, you know, some of that energy, some of that power, some of that fiscal support that has been, you know, really pushing the economy forward and keeping the stock market going up. I mean, those things are starting to slow down. All right, so that's what I pay attention to. But if you look at sentiment, let's take a look at sentiment. The AAII weekly survey, I mean, we did see a jump in bullish sentiment last week, but it's still pretty far below like historic high levels, like levels in the mid to high 50s on that bullish consensus, bullish sentiment reading. You know, when you get up like 56, 58%, I mean, we're at 48%, but, you know, in the past, you needed to get a number up around 56, 58%. On the other hand, bearish sentiment is pretty low. I think it's something like 20.6% or something like that. But still, even with the bearish sentiment, it's not at the lowest levels historically that we usually correlate to a market top. So we're kind of like in that mid-range to, you know, kind of overbought, but in a mid-range where it could go further. Same thing with the put-call ratio, by the way. The put-call ratio had one day last week where it was pretty low at 0.65. But if you look at the 10-day average, or if you look at the 20-day average, you know, those things have room to go down. In other words, we could see the market still go higher. One note, an additional thing to pay attention to. Bank deposits now at the lowest level in 2 months and growing at the slowest rate in, I believe it's 13 months. Okay, got to go back and look at my numbers, but still 13 months, 16 months, something like that. Bank deposits I like to talk about as, that's when people talk, hey, there's a lot of cash on the sidelines. There's a lot of cash on the sidelines. Well, the cash is, I'm not going to say it's drying up. I mean, you still got like 17 trillion in bank deposits, but it has slowed down. The growth of deposits has slowed down, and the level of deposits at the lowest level in 2 months. One more thing, bank reserves. Now remember, we had this big potential, time bomb with reserves. This goes all the way back to March. I was talking about this, how when the exemption on the reserve calculation and the leverage ratio, when that was coming off at the end of March, and I was telling you, look, we're going to have this massive reserve dump and the banks are going to be constrained by this. The Fed, and all this started to happen, okay? Reserves built up to record levels. And then what happened? We started to see the Fed engage in these reverse repo operations. I'm not going to get into the mechanics of that. Again, I talked about it on a number of videos. You could go check it out. But what this has done was successfully brought down the level of reserves. Reserves right now are down to the lowest level in 5 months. Okay, the Fed has like 1.3 trillion of these reverse repos on its books right now. That's a historic, never seen a number like that before. 1.3 trillion of reverse repos on the Fed's books. Those operations have been largely what is responsible for the draining down in reserves. So reserve balances at the lowest level in 5 months. All right. Last week, we saw the biggest 1 week drop in reserve balances in history. It was like 240 billion drop in reserves in 1 week. So what does this mean? Because obviously that's the question you would ask me right now. Well, it depends how you look at it. All right. On the one hand, it takes pressure off of the banks because, it takes away a big chunk of those assets which they would either have to allocate capital to, all right, or they would have to maybe slow down the rate of accumulation of other assets, particularly loans. So when you take that pressure off the banks, ostensibly, we could think, hey, maybe we're going to see a surge in loan growth. That could be good, right? On the other hand, the shrinking of reserves, and I got to tell you, it always fascinates me that we don't hear all these quacks and nut jobs who are always talking about printing money. They're printing money. Whenever the Fed adds reserves, what do you hear? They're printing money. They're printing money. The Fed's printing money. Well, if that's printing money, this is the unprinting of money. So you had now last week, a record unprinting of money. So if you're someone who believes that, printing money causes asset markets to inflate, to go up, then sorry, but by the same logic, you also have to believe that unprinting money is going to drag these things down. Now, me personally, I don't go by that. I will say, and I think the correlation, if there is any, is questionable. I've done studies on this. But the bank deposits shrinking, to me, that's something. Okay? That is something. So let me just end by this. Market tops are hard to predict, just like bottoms. I mean, these things tend to go farther than, most people expect. But you can see conditions changing at these periods in time. I mean, I see conditions changing, okay, with the flows, with the bank deposits, stuff like that. So I've always said, the market will go ahead or behind based on basic conditions. And when you start to see basic conditions change, that's like you feel that cool wind coming in. Like you feel like there's going to be a change in the weather. A cold front is coming in, to use a weather analogy. Anyway, that's it. Go to my website. Sign up for 30-day free trial of MMT Trader. If you like this video, please click like and subscribe. See you tomorrow. Bye.